bit of a technical issue. I'd like to welcome you to our European Studies Center seminar. I'm Kalypso Nicolaidis. I'll now be chairing this meeting. This is a meeting convened by Charles Enoch, who is our fellow at St. Antony's College and at the European Center, and who helps run our wonderful European Political Economy project here at the European Center, along with Professor Tim Blandas. And today we're going to discuss a very crucial topic in these times of COVID. Indeed, the fact that we all know intuitively, but that we need to document, that COVID is hitting different people, different regions, different types of groups, social groups, very, very differently. Distributional issues are coming back with a vengeance in the EU with COVID. And indeed, to discuss this issue and to give us both data analysis, but as well as prescriptive take on what is to be done vis-a-vis this crucial issue of regional disparity, we have a wonderful keynote speaker and three discussants. Our keynote speaker, Gergely Hudecz, is now at the European Stability Mechanism, which, as you all know, is all about helping member states deal with all sorts of ailment falling from the sky, starting with the financial crisis in 2008. But Gergely, you're going to say much more on the ESM, where you are principal economist in market analysis. And indeed, you came to the ESM 2 years ago from the private sector hedge fund Faro, Credit Suisse in London, having started your career in Budapest economics, and indeed having spent some time here in Oxford with us. So welcome back, Gergely, and thank you for being our keynote speaker. And then we will have three wonderful discussants, starting with Cinzia Alcidi, who is Director of Research at CEPS in Brussels, and who is supervising a whole team working on these issues of economic and social policies, has worked in Geneva at the International Labour Office, and indeed holds her PhD from the Graduate Institute in Geneva. Welcome, Cinzia. And then we will have Christian Odendahl, who is chief economist at another wonderful think tank, the Center for European Reform, has been very active and in the media in general on all of these issues for a long time around the Eurozone and the ECB, and holds a PhD from Stockholm. And finally, we'll have Mr. Jeffrey Franks, who also studied at Oxford as well as at Harvard, and is a unit chief at Northern 2 unit, and used to work at the IMF office in Paris and Brussels. So without further ado, I would like to, Charles, if you want to add anything, but without further ado, then I will turn to our keynote speaker, Gergely Hudecz, and then to our discussant. Floor is yours.
Good evening, everyone, and thank you very much for the invitation and the opportunity to present this paper. It's always a pleasure to be back, even if it's virtual this time. And also, I'm particularly happy to see some participants also from across the pond, which is particularly interesting, given part of the inspiration for this topic came from a comparison between the US and Europe. And we've been very much inspired by the work of Enrico Moretti, who wrote quite a bit about agglomeration effects in the US. And I think one of our starting questions was that should we expect, or is it desirable for Europe to become something similar? And how that should be managed. But before I jump into the topic, let me just say that this presentation is based on a paper written jointly with Edmund Moshammer and Thomas Wiese. And also I would like to thank you for the helpful comments and support along the way to Markus Rodlauer and Wolf Stroch, the chief economist of the ESM. So launching the topic, I tried to share a few slides here. Just give me a moment. Okay, can you all see the slides correctly? So I think maybe to mention where the other inspiration where this question came from is I think it was back in Oxford having discussions around 2008, 2009 about migration at that time mainly from east towards west, but then later as the crisis hit also from south to the north within the European Union. And I guess we were wondering whether this is desirable, is this going to last? Do we want it to last? Is it a structural shift? Is it a cyclical movement? So how to look at all the migration within the European Union, which I think we all cherish the possibility, but I think we also want to understand the economic drivers and consequences of that. At that time, the question started more with cross-country comparison, but since then, thanks to the OECD, we have good regional data to look at more in detail. And that, of course, was also a question much earlier. So going back as far as 1993, when Krugman wrote in his piece about titled "Lessons from Massachusetts," where he was worried that the monetary union could indeed exacerbate regional disparities by enforcing specialization and leading to different cycles in different regions with different specialization, which then would lead to different growth rates and different response to shocks. Also more recently, Delarazier in 2012 in a report written to the G30 also highlighted his concern that the economic integration could also lead to a higher degree of concentration. So I think both of these were not so well critiques of the initial idea of Europe and the monetary union becoming a quote-unquote convergence machine. So I think that was part of the question we wanted to look at. So to what extent these critiques hold and to what extent we should be worried about these. Now, why does this matter? So of course, as Kalypso mentioned, given the shock from COVID-19, we are all seeing the differentiated impacts, and I think we are all worried that these differentiation disparities may be rather persistent. And I think we all think about what we could do to avoid them or to address them. And of course, these pose both economic and financial and political risks. In economic sense, if you have different specialization disparities across regions, this could lead to cyclical heterogeneity, could make the policy response more complicated, and could also lead to structural divergence over the long term. And then, of course, from a political perspective, this could generate political tensions, could undermine support for the European integration process. And that's also, I think, which is these issues are very important to look at and address. So looking a bit more broadly at the literature, not just the critiques, I would probably put the literature we used and looked at in four broad categories. First, there was, of course, the initial debate that I just mentioned about the endogeneity of an optimal currency area by the seminal work from Franklin Rose, and then the critiques I just mentioned before. Then there's a long list of literature about the convergence process, first and foremost, Salai Martin, but then, of course, the piece about the needs of structural change by Roderick, and then there's a list of literature about the convergence within the European Union and Euro area, among them notably the piece by Jeffrey and his colleagues, and also Cinzia by her colleagues. So all those sort of informed our analysis here. Then the third category would be about the drivers of these possible disparities. One of them, possibly the global value chains. The ECB had done quite a bit of work there, and also had a working group looking at the issue, including also then there's this issue of business cycle synchronization, agglomeration effects that I just mentioned from Moretti, and then more recent work on the sector specialization and its impact on integration. And finally, there's the literature on response to shocks, which is becoming relevant with the COVID impact. Blanchard and Katz's seminal paper from 1992 on the US, and then the equivalent on Europe by Barry and Smith in 2015. And also more recently picked up by colleagues from the IMF for Cherry, and this year published very recently a comparison between the US and Europe. And maybe just to mention that there's of course a wealth of literature on urban economics, which we did not digest in detail, but that of course a possible extension of this work. We try to maintain a macro perspective as much as possible. So the highlights of our finding is, first and foremost, we find that convergence at the national level in aggregate is on track, but then underneath there is a divergence at the regional level. So the two can go very much in parallel. Second, we find evidence that economic integration remains a source of growth, but its impact is uneven. So while some regions are joining and benefiting from integration, others are falling behind. And then we find that there is an important element or impact of global value chains in this process. In a way, the economic integration and global value chains sort of magnify one another, and again, regions that can participate can benefit, also leading to agglomerations and strengthening agglomeration effects, but then there are others who are less able to reap these benefits. So to some extent, what we find is similar to Krugman's and de la Rosière's critique, which, as I said, deserves attention. But then we also find it important to highlight that integration has its benefits, and we find convergence in aggregate on track, which is, I think, very important to bear in mind in an era when we talk more and more about deglobalization, and we think it's important to highlight and maintain the benefits of the integration process. So let me show a few illustrative charts, and then there's much more in the annex if we want to go there in the Q&A session. So first, the message I just highlighted, the apparent contradiction between convergence at the national level and divergence at the national level, the regional level on the left-hand chart. So this the coefficient of variation is basically a measure of how far each country or region is away from the average. And you see that that this difference in average is declining across member states. So in a way, member states are getting closer to the average. But then the blue line on small regions is increasing. So basically, small regions are further away from the actual average of the European Union. On the right-hand side, you see more the underlying dynamics of small regions. You see the magenta line is the bottom 10%, the yellow line is the top 10%, and you see the difference increasing between the two over time between 2000 and 2016. Then looking at what type of regions or which areas are actually catching up or falling behind. On the left-hand side, you see a map where the shades of green show countries that are getting closer to the European Union average, and the shades of orange and red are the ones that are getting further or declining relative to average. And I think there are a couple of important messages here, observations. The first one is that, of course, as you see, the swathes of green area in the east is basically what's driving the convergence in aggregate. So new members do benefit. But then, importantly, when you look at the north-south differences, the picture is not that clear. So among the southern countries, you have areas which are indeed catching up compared to average, but then you have others which are falling further behind. But in any case, there is no clear north-south difference. Also, given our host in Oxford, I think it's also worth highlighting the UK, where you see that many of its regions are actually declining relative to average. The other important pattern I would like to point out, or lack of that, is that there's no clear city-led concentration. So you see some maybe a bit greener areas, say around Paris, or a few cities that you can note, but there's no clear difference between cities pulling away and rural regions falling behind. It's a much more differentiated picture. And also, if there's more granular data behind it, then you can see that actually there are more urban regions that are declining compared to average than there are increasing. And most of the regions that are catching up are actually the rural ones, which are close to agglomerations. So it's not clear black and white urban-rural difference either. On the right-hand side, you see a breakdown by country. We split the small regions into 4 categories of the initial 12 euro area member states. The lagging ones are the ones that have started below average and falling further below average. The pulling away ones, the brown ones, are the ones that start above average and pulling further away. Catching up are approaching the average from below. The catching down, the magenta, are the ones approaching average from above. So to put it very simply, yellow is quote unquote bad, and brown is quote unquote, the blue is quote unquote good when you have a catching up region. And there again, the message is that there's no clear north-south difference. So for instance, among the southern countries, you see Portugal and Spain with quite a few catching up regions. Whereas you would see that quite a number of regions are relatively lagging in France, or have a going negative distance to average. Maybe one interesting example also to highlight is Belgium, which has a relatively high share of regions both lagging and pulling away. So that shows some internal divergence there. Moving on to the next slide, to the statistical analysis, I wouldn't want to spend too much time on the details, maybe just the key takeaways. So when we put all this data in a regression model, we find that in average, poor regions grow faster than wealthier regions. And that's to say that convergence in aggregate in average is working. But then if you map that across integration into global value chains, you find that the ones that are more integrated are growing faster, and you also find a positive impact of educated labor force. Whereas you find unfavorable effects, especially in the euro area, of rigid labor and product markets. Then, of course, we started discussing the policy variables, so what could be done or should be done to have regions develop faster. And then quite intuitive observation also that better administration quality on the regional level also helps growth. Another piece of statistical analysis focusing more on the agglomeration effects, and here we used a gravity index that Christian and his colleagues used in their piece, so thank you for that. It was a very helpful reference for our work. And we find that, so the gravity index basically measures how far a region is from an economic center of gravity. So basically it's higher when a region is closer to a region which adds much of a country's GDP, and is a lower number when a region is further away. So you find that regions that are closer to economic centers are indeed growing faster. But then the measures we looked at for just measuring simple sectoral specialization, these are the Ballaster-Hoover indexes, either for manufacturing or services, we didn't find a very clear pattern. So it's not clear cut whether one or the other sector would be a clear silver bullet to foster regional growth. But for instance, if we look at an alternative measure to the gravity index, which is distance to capital of each region, there again we find results consistent with the gravity. So the closer a region is to a capital, the stronger its growth, especially in countries that have a non-federal setup. So there, interestingly, the state structure could also be a relevant consideration. And finally, but importantly, when we look at the impact of EU funds, we find a general positive impact, although that's more nuanced and more pronounced and more significant in the new member states of the European Union. And to conclude the descriptive section, I just would like to move on and to discuss a little bit the impact of the previous crisis and the current one. So in the previous one, we saw that regions that were the worst hit, that's on the left-hand side, have had persistently lower employment following the crisis. So the blue line represents the regions which experienced the biggest economic contraction and the employment in these regions. And the yellow line shows the ones that were the least hit. So you see a striking gap emerging between the two, that up until we have the data 2016 didn't come close to closing or catching up. But on the other hand, it did translate into migration, and that's what you see on the right-hand chart. You see again the lagging regions, the ones where most hit, the blue lines, where you see migration turning net negative around 2014, i.e. people are leaving, whereas you see a net migration into the pulling away regions, which is the yellow line. Maybe one caveat here is that the spike around 2015 may be exaggerated due to the refugee crisis, but still I think the pattern is pretty clear that you have a shift away from lagging regions to pulling away. And then, of course, you have the policy question whether that's desirable or sustainable. And moving over to the current impact, of course, the data is very recent and it's a very short time series we have. But some patterns we can already see. On the left-hand side, we used data on vacancy rates by sector and see how regions have been affected. I think the first observation is that you see that urban areas have been more affected given the high concentration of services. You can also see the more tourist-intensive areas more hit. But again, you don't really see a very clear or decisive split between north and south or east and west. So again, it's more to do with sectoral specialization and composition of these regions. On the right-hand side, you see the shift in business confidence, where the data runs a bit longer. So that's up until October, also capturing the start of the second wave. And there again, the message is relatively similar. Countries with so urban areas and regions with higher exposure to tourism are more exposed, excuse me. But maybe also worth highlighting the UK as a relatively badly hit country, or many badly hit regions there. So on that note, I would conclude the descriptive section with the summary thoughts. Again, repeating that convergence is on track, but these regional disparities are on the rise. And these disparities are not necessarily between new and old members, but it's more in old member states that we find what an OECD report called a middle income trap. So it's more the more affluent regions that are not keeping up to speed with productivity and sectoral shifts, which are falling below average. And we see an uneven impact of economic integration. We find that sectoral composition and productive differences matter. On that, I have more in the annex if there's interest. We found evidence that high productivity sectors and global value chains drive the catch-up and convergence process, and there are also advantages from being close to an economic center of gravity. And finally, we also found evidence that there is a hysteresis effect. Regions that are most affected by the previous shock had experienced persistently lower employment and investment rates, and that also translated into migration away from lagging regions to leading ones. So what are the policy implications? That's my last slide. First, we argue that one needs a two-track approach. On one hand, education and training is necessary. I think there's a strong consensus in the literature in that. But we highlight that there's also need to generate the demand for that labor, because otherwise we would only feed migration away. So if you only have educational labor supply, that could still contribute to migration away from these regions. So you have to generate the labor demand that keeps the educated people locally. Second, we argue that a well-calibrated industrial policy can play an important role in this, which can be also supported by the New Generation EU under discussion. And third, we highlight that flexible and equitable single market has an important role to play. As we said, integration is a supporting factor. So we highlight that the answer is not reversing the integration, but to help regions join that process more broadly. And it's important to create the linkages around the leading regions so that agglomeration clusters spread. Then this also raised the question about labor mobility. We've also experienced the impact of the recent lockdowns on one hand. On the other hand, we also learn how to work in the teleworking environment. That may have its advantages, and being able to, sorry, not the lockdowns, but the teleworking regimes, so that economic activity is not necessarily as concentrated as it was before. And finally, again, I think a strong consensus is that the quality of national, regional, and local administration plays a crucial role in supporting convergence and regional development. And on that note, I would stop here and thank you for your attention. Look forward to your questions.
Thank you very much, Gergely. Clearly, the mix of remedies is ambitious, and it would be interesting to hear you on whether indeed the so-called projects for industrial policy, New Generation EU, how much do they do the trick? What could be done better? And indeed, on this note, but thank you for a very, very deep and very granular paper. I find it fascinating that we really have to move beyond the East-West, North-South kind of traditional structural cleavages and really get into not only regions, but sub-regions, cities, etc., as you demonstrate through these beautiful maps. So, Cinzia, the floor is yours for the first set of comments.
First of all, thank you very much for having me here tonight. It's actually a great pleasure to have the possibility to comment on Gergely's paper and to share my thoughts with all of you. First of all, I think that the question, I mean, Kalypso already said it, the question you're asking is a very pertinent one, especially at this very moment. Not least because disparities, regional disparities have been increased over time for quite a long period. So to some extent, it's not something new, and that this may increase over time. And I will start from this point actually and make one general comment, which more on the policy side, and then I have a couple of more specific reactions. The first point, and allow me to do this, I'm based in Brussels. In Brussels, there is a lot of debate about the multi-annual financial framework, the EU budget and the EU resources, so I cannot escape a comment on basically what was the role, what could be the role of EU policies in to boost convergence. And I think here we really need to go back to the original design and thinking of the role of the EU and the role of national member states. So at the EU level, basically, there was this very fundamental idea that European integration through the free movements of goods, services, capital, and people would allow efficient allocation of resources. Social cohesion policies, structural funds, were there to help basically the lagging region to be able to catch up and to increase productivity. So the EU policies never had really the objective to do redistribution. So it was very much focused on how to boost the capacity to produce and to generate employment. At the same time, member states were those in charge of potentially doing redistributional policies. Now, if we look at the picture and the nice maps that you presented, basically we have an issue both at European level and the level of the member states. At the EU level, because the idea of shared prosperity seems to be challenged, if we look at the data, but also at the level of the member states, because a lot actually of this divergence that it were illustrated at European level actually happens also within countries. A couple of years ago, we did an analysis of regional trends, and basically what we find is that in a number of countries, you have this very same phenomenon of regions actually growing very fast and a lot of other regions lagging behind. So in this sense, there is a very fundamental question at the policy level about what should be done at national level and what could be done at a European level, also in terms of distribution of resources, in terms of achieving the objective of overcoming the disparities. Now, the second point is more specific, and it really relates to this idea of synchronization of cycles and specialization. I mean, specialization is a trend whereby you may have the risk of being exposed more and more to idiosyncratic shocks. So you may have different regions exposed to shocks. If you look at the idea of synchronization of cycle, this has been very much at the center of the optimum currency area because, of course, from a monetary policy perspective, you would like to have synchronized cycles because it would make it easier for the central bank to set up the monetary policy. I have been looking at synchronization of cycles over time. And in fact, what we experienced, that synchronization of cycles has been extremely high in Europe. I spare you on a comparison between the United States, but a couple of years ago, we produced a quite sophisticated, actually, indicators of synchronization of cycles. And basically, for the last 20 years, basically since the monetary union, synchronization of cycles was even higher in the euro area than in the United States. Now, synchronization of cycles is actually not an insufficient indicator to give us a sign of whether actually it would be easy for monetary policy to set up monetary policy in the sense that conditions are the same across countries. I think Paul de Grave was one of the first to point out that you may have cycles which are synchronized, but cycles whose amplitude is very different. So you may have countries doing booms and busts, and some others which are just moving around the output gap. So in this sense, even if you have a synchronization of cycles, you may still have a situation of difficulties for central bank to set the monetary policy. But my point actually would go even farther than this, and to highlight the fact that if you have cycles which are highly synchronized, you may be more exposed to systemic shocks. And this, unfortunately, the financial crisis and also now the pandemic are showing us that maybe systemic shocks are more common than we were used to see in the past. And if we are all synchronized and everyone is hit by a shock at the same time, we may all end up being in a problem. And this actually, all this discussion is not separate from the idea of risk sharing. And now we do not talk as much as a couple of years ago about risk sharing. I think is still a very fundamental feature of a union. And in practice, the more we are synchronized, the less risk sharing we can do. So in this sense, we really need to be quite wary, if you want, about the desirability of synchronization of cycles and the actual meaning of synchronization of cycles. And then the last point is about global value chains. I think in your paper, the incorporation of the role of global value chain is a very important one and an interesting one. And if I understand correctly, the main point is that the regions which are part of a global value chain had the possibility, or they managed actually to grow faster than others which were left out. I think this is a very important message. Now, moving forward, I think we need to keep in mind that also on the post-COVID, that the future may not be as the past. And basically, here my thinking would be in the direction of saying that global value chains are fundamentally based on comparative advantage. You break down in different parts the production, and you locate the production where the comparative advantage. This is a very simplified understanding, but this is basically the very fundamental mechanism. Now, we may be in a situation where some of the comparative advantage in some regions may be exhausting. The second point may be that actually global value chains, which are a lot about manufacturing, production, not only, but it's a lot about manufacturing, may be organized differently in the future, and in a way where actually labor is much less important than in the past. So I think one important question we need to ask ourselves is that if this thinking is correct, what would be the impact on development of regions in Europe, and especially what could be different trends between who is leading and who is lagging behind today in Europe. I will stop it here, and then we may have some more questions. Thanks very much.
Thank you, Cinzia. And this will be indeed questions for Gergely, including the point you've just made, which of course is at the intersection of structural factors as global value chains evolve with the characteristics of regions and sectors, but also policy. Because of course we know that the strategic thinking in Europe these days has a lot to do with global value chains. So it will be interesting to come back to this topic. And with this, I'd like to give the floor to Christian.
Well, thank you very, very much for the invitation and Gergely for the presentation. Of course, I've seen the earlier paper. It's an excellent paper. It's better than ours. Thank you so much for mentioning ours, but yours is much more elaborate and sort of was interesting for me to see what you did with the inclusion of the global value chains, which I agree with Cinzia is an important addition to this that we need to better understand. Maybe I'll start with the obvious, a bit sort of re-emphasizing why this matters, because what Gergely and his team have tackled here is politically a very important question. The regional divergence was not what the EU was built for, right? It was the promise of economic convergence that underpinned some of its economic appeal, particularly in the east of Germany and some of the economically harder hit areas in the south. And I think that the idea that economic integration and European integration benefits the already rich, I think is politically a very dangerous idea and easily exploitable. And I think it has an additional dimension because we know that income disparities between regions drive migration flows, and Gergely showed some of those in his presentation in this paper. In terms of migration from the refugee crisis, we are still used to, maybe also from the Brexit debate, sort of seeing migration as a threat, whereas the real debate in the next couple of years will be completely the other way around. It will be the depopulation of some areas and sort of the attraction of the rich parts of the Western Europe, pulling workers from harder hit areas and particularly from the east towards the west. Then what I think this paper highlights and what I think is important is that this goes beyond the divergence between countries, and it's very much a within country phenomenon by now. The sense of having evenly shared economic gains within a country and the left behind regions, I think we've discussed this at length since the Brexit referendum and the win of Donald Trump. Sort of fueling populism and the idea that this society is not for all of us. So I think this is just, adding to Gergely's motivation. It's an extremely important topic that we economists need to consider as well. But I think I want to add one sort of general economic point, maybe a bit of economic theory, but I won't go too much into detail, but it's a question of, is there an economic rationale as well for tackling regional divergence? And we know that there are externalities at work here, so that agglomeration creates spillovers, because if lots of smart people and good companies club together in one place, that they generate spillovers among each other. And also that we know that there's a better match between firms and workers within agglomerations such as big cities, and that creates additional economic output. So good people still want to move to the places with the highest potential because there's a wage premium to be earned. But the more people move to such a great place, the more there are congestion externalities, as economists would call it. So economic costs that you don't take into account, because the more agglomeration there is, the higher the cost for people who already live there. Then we have the negative externalities of the regions that are left behind. So people leaving regions, they are taking their economic potential with them, and they're potentially leaving a region with less economic potential, and this is harming everyone who's left behind. So this is sort of a very long-winded economic way of saying probably the market left to its own devices is agglomerating too much. And this is where sort of an additional economic rationale comes in for policy to not counteract sort of specialization as such, but to take account of those agglomerations and the benefits that it brings to the richer regions, and sort of help regions that are left behind economically to catch up, or at least not further fall behind. And this would be sort of my only sort of idea for the paper, or maybe a next paper, is sort of to look more into the urban economics of this. and integrate that into a paper on regional divergence, which is one of the things we wanted to do as well, and didn't have the time or space in the paper that we did. On the policy implications, I share everything that Gergely said in his presentation, so I could stop here, but I'm being paid in karma points to add my 2 cents to this debate. So here they are. So the first is, of course, this is part of what we wrote in our paper, but it's driving me mad during the COVID crisis since, is the full use of digital, because this is such a no-brainer that it drives me mad, because connectivity-wise, we are roughly in Europe where sort of Cambodia is, right? And this is not to say that Cambodia is an emerging market, so but they have sort of grasped the potential of digital a lot more. And the German Chancellor famously said that the internet is sort of new territory for all of us, which would have been cute sort of at the end of the 90s when she took power in the Christian Democrats. But she said it in 2013, and that's quite frankly an embarrassment, because it is brutally revealing of the complete lack of ambition that we have in the digital sphere in Europe. And so I think that investment in digital does not lower the appeal of the better regions. I think that is a mistake, to think, okay, massive investment in digital allows us all to work from wherever we are. And so we are probably all moving to, I don't know, the south of France. But it's sort of expanding the scope of a very successful place like London or Berlin, and making sure that more communities in the vicinity of these successful places can contribute in the economic success. And I think this is what Gergely also hints at in his presentation. The second is that regional policy, as we conduct it in Europe, needs to go beyond sort of the focus on subsidizing individual industries or focusing on investment spending on infrastructure and so forth. Because if we look at what makes a certain agglomeration successful, this is a very complex set of factors, which has to do with the education, with the structure with the existing structure of the economy, proximity to a value chain and so forth. So designing a sort of holistic regional policy, I think it's very complicated. I'm not saying this is in any way easy, but this is something where we need to invest more energy into, particularly when it comes to existing agglomerations that do not work very well. Because we have those, particularly the older industrial areas, and there is a difference sort of between those that are not working well. At least that is what we found, and be curious to know what you all think. But London and Vienna, and so bigger cities, also tended to be industrial centers in the past, but they have made the transition to a service-based economy because there was already sort of an existing cluster of services, workers and industry. And the pure industrial heartlands, I'm thinking about the rural area in my country, Germany, or the north of England, there was much less of that. And so they haven't reaped the potential of the services that they have. But I think the existing agglomeration at least offer a lot more potential with the right investment to become some of those higher productive hubs that the modern economy probably requires. And the third one, that is the Eurozone issue. We saw that the convergence machine EU sort of works if you look at Eastern Europe. But I think with the Eurozone, and particularly after the Euro crisis, I think it's relatively clear that it didn't work, even at the national level. Now comes the COVID crisis on top, which has hit Southern Europe quite hard in terms of the health count, but also, at least this is from what we looked at the regions that are hardest hit economically. A lot of them are in the south, and the fiscal space in the south is smaller. We've tried to compensate for that to some extent, but we are not compensating fully from it. And as Gergely showed, I think this is an underappreciated fact. The longer a crisis lasts in a place, the more hysteresis effects are there, both on the firm level, but also on the individual workers level and on the migration side. So the Next Generation EU Fund really was critical to make sure that we overcome this crisis without much further divergence, together with the short program and ESM support and the ECB and so forth. But I think we are not quite done with the Next Generation EU Fund. because even though I'm a typical cheery German optimist and think that this recovery actually will be quite substantial after the vaccine arrives, this recovery also needs to be sustained a lot longer. We saw after the 2008 crisis that there was quite a bit of divergence, particularly in the Eurozone, and Gergely and also our paper focuses also more on the structural underpinnings of this. But I think one of the reasons was that we had a very significant demand problem in the Eurozone, which hit the South a lot harder because we're contributing both with monetary tightening and with austerity to the existing structural problems that existed in these countries. I think that is now by now widely acknowledged. So if we return after the recovery of a vaccine sort of to fiscal austerity too quickly again, then we won't harm the already successful places like Berlin or, I don't know, Vienna or Lisbon, the sort of high productivity areas that also Gergely identified in his paper. But again, of course, we would most likely harm those regions that have been hit already. Yeah, those were, I realized those were 3 cents, not 2, but I didn't hope I spoke for too long, and I'm very much looking forward to the discussion.
Well, thank you, Christian. I'm looking forward to hearing Gergely's response, including on issues of how can we think outside the box in terms of agglomeration effects. Our colleague here in Oxford, Paul Collier, has also written very interesting stuff on that, including how Edinburgh got it by using culture. And so much else. And also thank you for reminding us that perhaps the lessons from the 2008 crisis haven't quite been learned as deeply as we would hope. So let's keep them in mind. But on this note, let me now turn to, last but not least, Jeffrey.
Thank you very much. Thanks for the opportunity to come back to St. Antony's, albeit virtually. And also I see some of my former IMF colleagues among the participants here, so shout out to you. This is a very timely topic, and as Gergely well knows, at one point when he was at the EIB, we had discussed doing a joint paper with him, and in the end we went our separate ways, and his paper was out first, so congratulations on that. But I will refer to the work that I've been doing with some colleagues in the Brussels office, which is very complementary to the work that Gergely has done on these regional disparities issue. Christian referred to the issue of why this is important, and let me just add one thing to what he says, and that is, we are seeing the increase of income inequality in many parts of the world, including in Europe, albeit not as severely as perhaps in the US and some other places. And this regional convergence question is really an interim step between looking at national convergence and looking at individual households. And what we see in the research is that there are places in Europe that don't see a particularly large increase in household income inequality, but are seeing an increase in regional inequality. And that is showing up in political implications. And I'm thinking particularly of France, where it's a country that has somewhat less increase in income inequality than the European average, but actually has had some serious political problems as a result of other types of inequality, including sort of those regional inequalities. So I think that's a very important point. We care about household inequality. We care about between country inequality from a European Union standpoint. But this intermediate stage also has some information that it can tell us. Now, if I do a quick recap of what Gergely's paper says in terms of some of the drivers of regional inequalities, he talks somewhat about countries that or regions that maintain their manufacturing or were able to build up professional services did better, that intrasectoral productivity differences also made a big difference. And I think here, this is part of a broader phenomenon of, the firms, this increasing distance between the leading firms and the rest of firms in terms of productivity growth. And that is an agglomeration effect in and of itself, with the big digital firms increasingly having a larger and larger gap in terms of productivity with others. And then he also talks about the agglomeration effects, which I think are are obviously also very important. And I very much appreciated the insight that it's not so simple as rural, urban, or north-south, because I think that's very true. One of the things that the paper notices is that regions that are next door to an agglomeration are doing well. And an interesting question that we might be interesting to look at in future research is it just because people are living farther and farther away from the metropolitan centers and commuting in, and that's what we're seeing in terms of less inequality, or is it in fact that there is some spillover effects in terms of firms setting up work in regions adjacent to the big centers? The other issues that they look at, which I think are very interesting, are the tradables versus non-tradables and the global value chain questions, which are very interesting driving factors in this inequality. And finally, he mentions education levels and governance quality as being important variables here. Now, the research that I've done with some colleagues, we have a lot of overlap with that. We find some of the same variables being important, particularly the governance quality issue and education effects. But let me highlight two complementary things that we found in the work that I've been doing. One is that it's not just education levels, it's investment in education. And that's probably obvious, but I think that it's not just the level; it's the first difference that makes it an important impact there. And also investments in physical capital. So regions that invest less do less well, including investment in research and development. And the second area, which is kind of originally was a way out there variable for us, but turned out to be very important, is quality of health of the residents of a region. That is to say that what we seem to find is that less healthy regions do poorer economically, and they don't converge. And this, you could say, well, there's some endogeneity here, that regions that are doing poorly, it's just the less healthy people that are left behind. We tried to do some controls for that, and we still found the effect, but we also found an incidence of the so-called deaths of despair. The work that Angus Deaton and Ann Case have done in the US primarily, there is a similar phenomenon in Europe. That is to say, lagging regions end up with higher levels of suicide and drug addiction than regions that are not lagging. And that can be both a result of poor economic performance, but also can be a cause of poor economic performance. On the policy side, I certainly agree with all of the policy recommendations that Gergely mentioned. Education investment is certainly going to be important. EU funds investment, I think, can be very important because of this important effect of investment on helping regions converge rather than diverge. Gergely mentions the regional adaptability of product and labor markets. There's some structural work from some colleagues in the IMF that suggest that that's also a very important factor. And transfers more generally matter. In our own research, we see that there is a big gap in the lagging regions between GDP per capita and disposable income per capita, which suggests that current transfers are cushioning some of the blow. Now, at some point, you have to think about whether cushioning that blow also can cause long-term problems, because you're encouraging people not to move to regions where they're more successful, but stay in areas where their consumption is cushioned by the transfers. The final point I wanted to mention is just some speculation on the COVID impacts here. As has been mentioned, the initial impacts of COVID in many countries seem to be more centered on urban areas rather than rural areas. So agglomerations may have been more affected, and you would think, well, COVID might have some positive distributional effects in that respect. Also, the idea that maybe COVID has interrupted global value chains. Well, then the advantage of those who are more integrated to global value chains could disappear or be ameliorated, and that might cause a greater convergence. Although both of these effects would be the so-called catching down effects that Gergely mentions, not catching up effects. It's slowing down the faster regions rather than speeding up the slower ones. The working from home effect, and Christian mentioned this as well, that's a bit ambiguous, because on the one hand, you could think, well, now I can work from anywhere. I can go out and live in the mountains and still do my job, and so the incentive to agglomerate is less. the contrast on that might be that we have to think about why people agglomerate. One of the reasons they agglomerate is because all the jobs are there. But another reason that people agglomerate, and there's been some research on this, is because they like the cultural amenities of being around a bunch of highly educated people and going, having all the cultural amenities that go with that. Those cultural amenities are certainly temporarily in suspense, but you could easily see a case where somebody working for a manufacturing firm in a relatively depressed area might say, okay, now I can work from home because I'm doing the IT work. I'll just move to a big city where I can live with people like myself. So those agglomeration effects, working from home may or may not help the lagging regions in that respect. Certainly, if you take the point that I made about the research that shows that the lagging regions tend to be less healthy, that certainly would suggest that COVID is going to have a much greater negative effect in those areas. And we're starting to see that in many countries. In the US, it was primarily an urban phenomenon. COVID was primarily an urban phenomenon initially. Now we're seeing far and wide the biggest negative impacts in the rural and in the more lagging regions. And the fact that those areas are less healthy to begin with suggests that that could be a much worse effect. And if those effects persist over time, the hysteresis, as Gergely mentioned, hysteresis tends to be a bigger problem in the lagging regions than in the advanced regions. So if you have a similar shock in both parts of the country, you could see that those effects might be more persistent in the lagging regions than they are in the more advanced regions. So for all those reasons, I think that COVID could very well be a shock that has a greater negative impact on the lagging regions than it does on the more advanced regions. And I'll stop there. Thanks.
Thank you very much, Jeffrey. And I note that all of you have been citing your own papers as well as usually saying Gergely's paper is much more better than mine, but here is mine. So I hope we can get the links for all of the papers that you have cited so we can put it, Charles, I'm turning to the boss here, put them up on our website at the European Center together. I think that would be really useful and nice. But I think, Gergely, there are really two aspects here. The diagnosis, yes, convergent, but with different emphasis on agglomeration effects, etc. But then also the prescriptions, what do you think of those that have been added? I'll just give you just a few minutes because I'll just want to turn to Q&A afterwards. And I'm watching the chat. So if you would like to ask a question, either for me to read your question or to ask it directly, please write it in the chat. But I would say, Charles, if it's okay with you, if we can go until 6:30, that will give us enough time for the Q&A too. And with such a sumptuous, wonderful panel, it would be a pity to stop earlier. So, Gergely, the floor is back to you.
Well, thank you, and thank you for all the comments and additional insights. As I said, all the other papers have been a great inspiration to us. So it's a lot to take in, and so I'm not going to address all the comments, but maybe try to group them. And the first issue that was, I think, shining through in many of the comments had to do with migration, and to what extent migration leads to political tensions, to what extent it's economically optimal to generate migration towards agglomerations. So I think there is that's at the heart of many of the of the issues we're facing, and then of course there is the question to what extent that's desirable to facilitate, and then of course have to do with the policy response. That is how can people or regions become more productive where they are, and how to facilitate that. So I think there is so for maybe linking that to the cyclical question that Cinzia asked, because so one could argue that migration is a natural response if you have a cyclical shock, and to what extent, to some extent, that I think was sort of assumed to be natural or working as a stabilizing factor in the euro area and in the European Union. But I think the question that we have not been sort of settled or addressed is that to what extent this is to become structural and long term, and to what extent it is politically acceptable for these cyclical movements to become a persistent feature. And on that, I think there are two lessons. One is that education in itself is not only the answer, because again, you have all the additional effects of value chains, of agglomerations, the need for labor demand also, so that there's an additional element of regional development policy. The second is what we've learned from the crisis, and maybe areas where there's room for improvement, because I think, as Christian put it, we've learned from the previous crisis that to sustain demand is essential to prevent the hysteresis effects. But when that demand is sustained and generated, I think it has to be done in a way that's conducive to structural change and supports productivity. So it's not only compensation, but it's also facilitating and spreading development and growth more broadly. And I think that's where the lessons we highlight from agglomerations and value chains come in, because that's the question we're asking: how can we spread those benefits more broadly? And of course, digital is one part of that answer. I mean, this seminar is an excellent example how you can do a seminar from Oxford with people from across Europe and across also from the US joining. And I think that is one template that one can try to apply more broadly. Also, maybe compensating for some of the lack of cultural amenities that Jeffrey mentioned. That you have more connectivity, and you, especially dialing from Luxembourg, that's a great thing to do. But then, of course, come the question of value chains, and I think there is some of you highlighted that value chains are under pressure and challenged by COVID. But I think that's why it's important to highlight that there was, quote unquote, an upside, that there was an integration factor. So one have to think about how these benefits can be replicated, as we put it in the paper, how global value chains can be complemented by European value chains. So it's not a dismantling or anti-globalization answer that we're discussing here, but more how to open these up, to put it that way. And again, all these for broader economic benefit, and then goes to the point raised by Christian about the economic rationale to do this, because simplistically one can argue that you have a higher return because of agglomeration effects if you concentrate economic activity. But there is actually a very nice OECD report showing that how enhancing productivity in other regions can be part of a broader growth strategy. So if you are able to utilize those resources locally and generate the agglomeration effects there, seed new clusters, that could overall lead to a better aggregate outcome. So it's not a zero-sum game compensating lagging regions. Maybe one way to put it, it's not coming from me, so I don't credit for it, but I think it's a very illustrative way to say is it's not about taking the countryside to the city, it's about taking the city to the countryside. So it's being able to spread those benefits more broadly and avoid the need for concentration. And on that, I would stop, and those were just sort of general reflections of the comments we had.
Thank you very much, Gergely. And I do want to turn back to our panel in a moment, but before I do so,